Hello everyone, welcome to chapter 29 of CPI. In the last chapter, we discussed my personal approach to high time frame analysis. I shared everything to you about how to properly conduct your analysis in the best manner, in not only the best, but the most objective, mechanical, and systematic manner on the higher time frame. But obviously, you know that our whole analysis doesn't just stop at the higher time frame. In fact, that's just the beginning. The analysis has to then be continued down to the lower time frame in a top down manner, and basically integrating all of the analysis with each other to properly form a directional bias for the lower time frame, and then to frame entry at the end and actually execute our entry model. This chapter is going to be about intermediate time frame analysis and my personal approach to it, and how to actually refine the monthly analysis on the monthly time frame down to the weekly and daily time frame. So, without any further delay, let's get into the chapter and let's discuss its details. The focus of this chapter in this whole analysis is going to be to first of all determine the impact of the higher time frame on our respective asset pair or instrument. Uh, the next focus is going to be to identify and determine the directional bias and drawn liquidity for the weekly time frame. We're going to refine the higher time frame monthly drawn liquidity down to the weekly time frame in a systematic approach. And we're going to be determining both our short term and long term drawn liquidity respectively. We're going to be talking about the correct dealing ranges and how to actually select them, and not only that, but selecting the correct key levels within those dealing ranges. And all of that analysis is going to lead us to conduct a detailed analysis on a weekly basis. This is the type of analysis that we're going to conduct at the start of each week to determine our directional bias for the rest of the week. Now moving on, right here you can see all the concepts that we're going to be using to conduct our analysis on the weekly basis. On a weekly basis, right here you can see we have the same concepts that we had for the monthly time frame. That's because we don't need any different concepts. You're just going to be making sure to integrate the higher time frame analysis with this weekly time frame analysis and refine it down to specifics. We've got the open, high, low, close, market profiles, order flow, and then the rest of the concepts, and all of that is going to lead us to our determining our weekly directional bias and drawn liquidity, and they'll be clearly defined and measured. Now let's move on. Here in this slide, we're going to break down this step-by-step approach for intermediate time frame analysis using the open, high, low, close concept analysis. First of all, we're going to dissect the current monthly and weekly candles based on the open, high, low, close concept. And this means we're going to study the behavior of these candles to figure out where we are in the current sequence. Are we building liquidity or currently consolidating, nearing the weekly or the monthly candles open, or maybe we are ready for a candle range expansion, right? This analysis will help you map out the narrative for our intermediate time frame analysis. Next up, we're going to build a price-based narrative to anticipate and predict how and when will price move toward the drawn liquidity. And once you understand the candle sequence, you're going to craft a particular story, and you're going to ask yourself, where is price likely headed? Are there liquidity zone above or below the market that it's targeting? And then you're going to finally support your narrative with your high time frame analysis that you would have already done, and you're going to use the insights and the analysis from your monthly time frame, including the key levels and candle ranges, to validate your predictions and validate your anticipations and expectations for the weekly time frame. And this will ensure that your intermediate analysis aligns with the bigger picture in the broader market context. Moving on, here in this slide, let's break down the process of market profiles for intermediate time frame analysis. First of all, you're going to determine the current market profile. You're going to ask yourself, are we in an expansion phase where the price is trending in a clear direction, or are we in a consolidation phase where price is in a range bound condition? And this is going to be the foundation of your analysis, right? Because once you understand the market current behavior, then you can make much more informed decisions based off of that. Next up, you're going to refine those profiles into advanced profile. Once you know whether we are in a consolidation expansion, you're going to take it a step deeper and ask yourself where the market, whether the market is showing a sign of a reversal, a retracement, or maybe it wants to continue its trend in its range expansion. And this refinement will help you narrow down what's likely to happen next. And then you're going to look for supporting ideas to validate your premise. And this is where you will challenge your analysis, right? You're going to ask yourself logical and critical questions. You're going to ask yourself, does this price action confirm my expectations or not, or does it refute or rebut it, right? And are there any other external confluences that supports or refute my trading idea in my expectations for price? And finally, you're going to combine these insights with the higher time frame and open high low close analysis that you would have already done. And this step will basically ensure that your intermediate time frame analysis and your intermediate time frame view aligns with the bigger picture. And you're going to use higher time frame directional bias and key levels to add confidence and clarity to your narrative. Once you've done all of that, you're then going to determine the order flow. Uh, the analysis is going to be the same you perform on the monthly higher time frame, but you're going to refine that down to the weekly specific levels, right? First of all, you're going to measure the order flow or the advanced market structure of the market. Next up, you're going to assess whether price is rejecting lows, breaking highs, or rejecting highs and breaking lows. And then you're going to look at the short term, intermediate term, and long term highs and lows to see how price interacts with them. If price is ranging or consolidating, you're going to apply the range dynamics principle to anticipate where price might be headed next. And finally, after determining the overall order flow, you're going to tie down all these observations together to get a clear understanding of where the market is headed and exactly why it is headed. Moving on, and then we're going to dive into dealing ranges and key levels for intermediate time frame analysis. First of all, after determining the high time frame down liquidity and directional bias, you're going to break down the selected price range or current dealing range into premium and discount zones. And then you're going to identify the correct key levels within these premium and discount zones and select them based on the market context and narrative. And even within those dealing ranges, you are also going to select the respective CRT or candle ranges that actually supports your anticipation expectation for price and that you can use to frame your entry around or to build potential trade ideas around it. Moving on, right here in this slide, you can see that we've got this whole summary. First of all, I started off with determining the current market profiles, right? And this involved identifying whether the market was in a consolidation, expansion, reversal, or a retracement profile to understand the phase that we are in. And next, I measured the order flow and I observed how price was interacting with key levels, and I determined the market directional bias based on its structure and framework. Then I confirmed my analysis with correlated assets by comparing related markets, right? And I was able to validate my findings and strengthen my confidence in the bias. After that, I selected a portion of price to trade within known as the dealing range, and this narrowed down my focus to a manageable and a relevant area of the chart where I chose relevant key levels and candle ranges to support my idea. And from there, I then defined those key levels in CRT even more on my respective time frame. And then finally, this entire process led to defining a directional bias for me on the weekly time frame. And from here, I would refine this analysis even further by applying the same methods of analysis on the daily time frame, which would make the process even more precise and accurate. Moving on, right here you can see this monthly chart from the previous chapter. You can see what we had done is that we had taken out this swing low, and we had taken out this swing low with this particular candle, which then acted as a candle range for us, right? So the swing low was the key level for us, and this is the CRT for us. Price purged the CRT, and then once it was purged and price closed higher, price then expanded higher towards the drawn liquidity, which was high. And by refining it down to the weekly time frame, you can see that once the swing low was purged, we had this order block formed right here. Price then engulfed that particular candle, which turned into an order block, and then price tested it and expanded higher.